So why is this going on right now? Why is the Nasdaq diverging? Why is Bitcoin diverging from 2020? Why is it diverging here? Why is it diverging here? And the answer is, you haven't heard this from anybody yet, but I talked to you last month in the Drinks with Raoul that the thing that is happening is the Fed were tightening because the Treasury General Account was being built ahead of the government shutdown. The Treasury General Account got built. Meanwhile, the reverse repo got drained to zero. So there's one lever. If they don't use the balance sheet, there's one lever left for the Treasury and the Fed to use in driving liquidity currently. And that is the Treasury General Account. That's the checking account of the Fed. And so they've been building it up, putting some cash in the system ready for this moment. And what they then do is they will then release it by spending that money. But there's an issue with spending that money. There's a government shutdown. There's nothing to spend it on.
When markets stop making sense, liquidity is usually the missing link. Right now, that's exactly what's happening across global assets, from tech stocks to Bitcoin. Everything that should be moving together suddenly isn't. The Nasdaq is diverging, Bitcoin's breaking its usual rhythm, and traders are asking the same question: why now? The answer, according to Real Vision CEO Raoul, lies deep within the plumbing of the US financial system, a place very few investors actually look. In his latest analysis, Powell explains that the US government's shutdown has frozen a critical source of liquidity, the Treasury General Account, or TGA, essentially the government's checking account. While the Federal Reserve has already drained the reverse repo market to zero, the Treasury has been quietly building up its cash reserves, waiting for the moment to spend. But with Congress gridlocked and no budget in place, that money can't flow into the system. The result? A temporary liquidity freeze that's hitting risk assets, and crypto hardest of all. Bitcoin and the broader crypto market sit at the farthest end of the risk curve. They thrive when liquidity expands and suffer when it contracts. According to Powell, this isn't a sign of structural weakness, but rather a short-term consequence of frozen capital. More importantly, he believes this cycle will not be like the past 4-year Bitcoin cycles. Instead, it will extend much longer, into 2026, driven by global liquidity injections from major central banks, especially China's PBOC. Once the taps open again, the move higher could be sudden and violent. So, how long until the system restarts and liquidity floods back in? And when exactly does Raoul expect the crypto markets to recover and surpass expectations? We'll break it all down in this video. But before we dive in, make sure to like this video, subscribe to the channel, and hit the notification bell so you don't miss our next deep dive into the macro forces shaping Bitcoin's next bull run. Thanks, and enjoy the video.
Interestingly, gold actually follows, or actually is, basically current financial conditions. So financial conditions and gold are all in the future. And so when you look at gold against total liquidity, it's telling you liquidity is about to explode. And that's a really interesting thing. Gold has shifted around. Sometimes it's real rates, and other times it's other things. Other times it's just the dollar. But right now, gold's highest correlation in this kind of Bayesian world where probabilities shift and correlations shift is it's all about financial conditions. And it's basically telling us the financial conditions here are going to explode weaker. Okay, super interesting. Will it work out exactly like this? Hell no. Will it be rhyming? Hell yes. So liquidity is rising. Okay, so what's really going to push a massive rise in liquidity? Well, hello, the PBOC. We've been using this chart of the Chinese central bank balance sheet, which is the only major government using their balance sheet right now, versus 10-year bond yields with like a 2-year lead. And it's been working perfectly since we started pulling this out in 2022. And what it's suggesting is we're now in the acceleration of the use of the PBOC balance sheet. Balance sheets are like the most powerful force multiplier. Somebody's going to be using one somewhere. Back in 2017, it was the Chinese that drove the entire crypto cycle because the US was tightening rates, and it was doing QT. I mean, all of the bad things, all ridden by the fact that the PBOC, the UK, and the ECB all stepped on the gas. The PBOC is going to be stepping on the gas. Interesting. look when it peaks in 2026. That's super interesting. We also know that gold leads by a significant period of time, about 12 months versus ISM, and that's telling us that, in 12 months' time, we're still not peaking the business cycle. Has gold peaked today or not? I'm not sure. I still kind of think it goes another leg from here, but we have some more volatility, more correction, another leg higher. I'm indifferent to it. I'm not in the gold trade right now, but what it does is give us a lead on the cycle. So go back to the gold chart. This is the chart that everyone on Twitter has got a different time horizon for. This is the one we've been using. I've not really shared it super publicly, but this is gold with a 188-day lead, so 6 months lead versus Bitcoin. What we've got is a slight divergence against, I don't think you can see my mouse, but there's a slight divergence versus that chart. And that doesn't look anything on the chart. I mean, it's noisy, right? Nothing fits perfectly. Keep trying to say this 1,000 times, and everyone goes, "Oh, why did that chart break?" It's like, morons, please listen. You're not serious people. So what it suggests to me is we have catch up to do, and that goes into the end of the year. And then we'd have a period where everyone says the cycle is over, and what happens is nothing. The bears get really aggressive, and it doesn't work. The bulls get miserable and start questioning their own lives and whether they this whole thing up, and nothing happens. And then eventually, April, May, as ever, it explodes higher again. That's what this is telling you. I think this is probably the closest estimation in my head and what I think plays out. Let's go to April 17 to 18. There's a similar pattern here, similar kind of part in the cycle. Obviously, we think the cycle extends, but there is similarities, and we've got alligator jaws. Oh no, alligator jaws. What normally alligator jaws will do is Bitcoin should be at about 140,000 now, but it's not. So it's diverged a bit. Oh, it's all broken, it's failed. No, I'll explain why. Because there's always reasons why things are different. Here's Bitcoin 2020 versus 2021. This seems like it's the right point in the cycle versus the previous chart, which was the final year of the cycle. This is the prior year of the cycle. And what we've got is this divergence again. I mean, look how beautifully tight that correlation is. Alligator jaws. Oh, well, it's all broken down, Raoul. This is all worthless. Spurious correlation, blah, 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 blah. Sort of. NASDAQ versus Bitcoin. NASDAQ's been doing great. I've seen all of you kind of paper-handed ninnies all going, well, I'm just going to trade tech stocks now. And what's hilarious is the amount of people from crypto have gone, well, it's gold. I'm going to buy gold instead. It's all the same trade, leads and lags, but everything divided by Bitcoin is down 99.9% over time. Just remember that when you're switching around. Tech stocks, I love, great opportunities. NASDAQ's been stronger than Bitcoin. What gives? Aren't they supposed to be all driven by the same liquidity factor? Well, what gives is, here's the liquidity factor, global M2 and NASDAQ. I'd rather use total global liquidity, but this is a weekly chart, so it makes it easier. Basically, 97.5% of all of NASDAQ is explained by the one variable, the most powerful macro variable on Earth, liquidity. And this is a proxy for total global liquidity. In Bitcoin, it's 90%. But occasionally, look at this in the NASDAQ. Do you remember when we came out and said, you need to buy the NASDAQ, it's well overshot versus liquidity? Guess what happened? The alligator jaws shut. We saw the alligator jaws the opposite way around here. It works because it's 97% of everything that happens to the NASDAQ is the one variable. So why is this going on right now? Why is the NASDAQ diverging? Why is Bitcoin diverging from 2020? Why is it diverging here? Why is it diverging here? And the answer is, you haven't heard this from anybody yet, but this is, I talked to you last month in the Drinks with Raoul that the thing that is happening is the Fed were tightening because the Treasury General Account was being built ahead of the government shutdown. The Treasury General Account got built. Meanwhile, the reverse repo got drained to zero.
Raoul Pal has been clear that this current slowdown is a pause, not an end. As he wrote recently on X, the government shutdown has halted the drain of the TGA plus no reverse repo to drain, which means less liquidity, temporarily, and sloppy crypto as the pointy end of the liquidity spear. This too shall pass. What he's saying is that the system hasn't broken. It's simply holding its breath. Without government spending, liquidity can't circulate. And when liquidity dries up, the assets farthest out on the risk curve, like Bitcoin, show it first. But as soon as fiscal spending resumes and liquidity returns, those same assets lead the recovery. And that brings us to the core of his latest analysis, the mechanics of what comes next. As Powell explains, there's one major lever left for the Fed and Treasury to pull, the Treasury General Account. Once the shutdown ends and the government begins spending again, that cash will pour back into the economy. Liquidity will snap back, the pressure on crypto will ease, and the pointy end of the spear will begin moving higher again. Let's hear Powell break down exactly how that process unfolds and what it means for the months ahead.
So there's one lever. If they don't use the balance sheet, there's one lever left for the Treasury and the Fed to use in driving liquidity currently. And that is the Treasury General Account. That's the checking account of the Fed. And so they've been building it up, putting some cash in the system ready for this moment. And what they then do is they will then release it by spending that money. But there's an issue with spending that money. There's a government shutdown. There's nothing to spend it on. So what we've got is this period since kind of end of September, October, when, guess what, crypto started underperforming, where liquidity has stopped at the lows. And this is the lows going back several years. And that's normally driven by the Treasury General Account rebuild, and then it normally bounces back in quarter end. But we have both of those factors, and it's not bounced back because there's nothing to spend the money on because the government is suspended right now. So what you get is this weird pattern where there's no liquidity because they're not using stuff like the SFR, SLR, all of these other acronyms to inject money into the banking system. They're trying to get there. The Fed is cutting rates, but cutting rates doesn't really change liquidity. It changes financial conditions somewhat, but it doesn't change liquidity. So liquidity is kind of trapped in the US. And the US is quite dominant in liquidity because the dollar is the world's reserve currency. So this period of the government shutdown means that crypto's weak. Why is NASDAQ not weak and crypto is? Well, NASDAQ's been choppy. It's basically where it was when this whole period started. But crypto's weaker because crypto's further out the risk curve. There are no earnings in crypto, really. These are very long duration assets. So they are the most susceptible to liquidity. If liquidity withdraws, they fall the most. If liquidity comes in, they rise the most. So here we are where liquidity is being withdrawn or withheld, not really withdrawn. They're not trying to do that. They have no choice. They have no way, unless they can get through stuff through Congress, to inject liquidity unless there's a mini crisis. And we've seen a bit of wobbliness in the plumbing system, but not enough for them to actually go and do something to inject liquidity. So I'm sure Scott Bessent and I'm sure the Fed are looking at this thinking, Christ, we've got no liquidity. We saw South Korea asking for unlimited swap lines. What does that say? It tells you the eurodollar market is too tight. So US liquidity, because it's still constrained by this one factor, there's no balance sheet being worked, there's no reverse repo being drained. We've got this one factor, and that's supposed to be driving all the US dollar liquidity. Well, that struggles. It struggles because it's not big enough to go all the way out to the eurodollar markets and to the South Korean banks and the European banks and the Japanese banks. So they need swap lines. So it's telling you that things are tight. And we know the answer to tightness in liquidity. It is the opposite. It is more cowbell. So as more cowbell comes in, things snap back. And that's where we are. We're at this kind of super mini version of 2019 where the Fed pivoted and everything had to change because of this liquidity issue. And this liquidity issue is what's driving stuff now. So I hope I've explained it to you. The government shutdown, yes, there's a couple of guys talking about it ending this week. The prediction markets are like mid-November. So let's think this could go on a little longer than expected. And in which case, liquidity is not coming into the system unless the Chinese really push further or somebody else, the Europeans, the Japanese, or one of the other large economies, the Canadians or the Aussies or the Brits do something. We need everybody in concert or at least not fighting it. And the Fed are kind of drawing down liquidity. And that is the reason why we saw this. The year-on-year global liquidity is being driven by the Fed here, pulling back a bit in liquidity, not from their desire, but their constraints of having no reverse repo. And so they have to figure out how to inject liquidity because they want this number, the ISM, to go up because the ISM going up wins them votes. And remember, next year is a voting year. When we go back to another voting year, 2016, 2018, what we got was global M2 growing nicely, and this global M2 today doing the same kind of thing. So again, contextually, everything is good. Okay, bit more interestingly, into markets itself, Bollinger Bands. Bollinger Bands kind of tell you how much volatility there is within the market. And sorry, little snack. I do love those peanuts. And we are at the third lowest, second lowest bandwidth of Bollinger Bands in history of Bitcoin. Okay, so it's interesting. And interestingly, it reverses soon after. And interestingly, it always produces higher prices. And we pointed this out the last two times it happened. And the last two times it happened, it went up 107%, 206 days later. So whatever that is, 9 months. And it went up 125% 9 months later then, even though it had been much higher than that. And then back in 2016, which is like a similar period to now, it was up 189%, and it had been up over 200%. So the point being, these compressed Bollinger Bands, John Bollinger, I think, was on X talking about this, is like, these are an opportunity. Okay, seasonality. We're at a really good point in the seasonality chart. And you would imagine that we are now diverging from this because of the, repeat after me, the Treasury General Account and the government shutdown. Once that comes back in, we start climbing the curve to the end of the year. Does it start in November and we play catch up? Either way, we should have a back end of the year that's very strong. And in the end, you'll have forgotten all about this shit, much like we told you in April 2024, September 24, April 25. I mean, it's all the same shit. You forget about it after a while.
Raoul Pal's thesis is simple but powerful. Liquidity drives everything. Every major market cycle, whether in tech stocks, gold, or crypto, has been defined by the ebb and flow of global liquidity. Right now, we're in a temporary drought, but just beyond it lies the next surge. The Federal Reserve can't tighten forever, and the US government can't stay shut down indefinitely. When the Treasury finally starts spending again, and when global central banks, particularly China's, step on the gas, liquidity will roar back into the system. And when that happens, the assets most sensitive to liquidity, Bitcoin, Ethereum, and the broader crypto ecosystem, will lead the charge. According to Pal, this isn't just a rebound. It's the setup for an extended cycle, one that could peak in 2026. Unlike past 4-year Bitcoin cycles, this one is being fueled by synchronized monetary and fiscal shifts across the world. Once the liquidity spigot opens, all the conditions align for another explosive phase. As Pal puts it, the charts might look messy, but they rhyme. History doesn't repeat, it echoes. So, while the current weakness might feel uncomfortable, it's also the prelude to opportunity. As liquidity pressures ease, volatility compresses, and the macro tide turns, the market will reset, and those positioned early will benefit most. The data, the timing, and the macro framework all point in the same direction. A powerful resurgence in crypto as liquidity floods back in. And drop a comment letting us know what you think of Raoul Pal's extended cycle thesis. Do you agree that 2026 will mark the next major crypto peak? If you found this breakdown insightful, make sure to like the video, subscribe to the channel. Thanks for watching, and we'll see you in the next one.